Hello everyone, welcome to my course on capital investment. This is module 2 of this course. In this module, we are covering capital budgeting and this is the first lecture of this module. In this lecture, we will cover some of the basic principles of capital budgeting. Let's look at what will be covered in this lecture first. First of all, we'll cover what is meant by capital budgeting. Then independent projects versus mutually exclusive projects, then project sequencing, unlimited funds versus capital rationing, and finally sunk cost versus opportunity cost. So what is meant by capital budgeting? In general, capital budgeting is the process of evaluating and selecting long-term investment. With the help of capital budgeting, corporations and financial managers decide which projects they should undertake to increase overall value of the firm or business. So capital budgeting is about how to allocate firm's capital or funds to different projects. And capital budgeting also helps the firm to increase overall value of the business or company. Now let's look at how independent projects are different from mutually exclusive projects. When a firm evaluates projects at a time, it is important to recognize whether the projects are independent or mutually exclusive, and there are different tools to evaluate projects. If projects are independent, in this case, acceptance of one project does not reject other projects. That means if a firm has 5 profitable projects, firm can accept or firm has the ability to accept 5 profitable projects. So if the projects are independent, a firm can accept all profitable projects. On the other hand, if projects are mutually exclusive, acceptance of one project means the firm has to reject other projects. This is because the firm has limited funds, so firm cannot accept all the profitable projects. So firms need to select the best project out of many projects. Project sequencing. Some projects must be undertaken in order or sequence. This is because the firm does not have enough capital or fund to invest in all projects. So the firms need to undertake projects in a certain order or sequence. For example, if a project undertaken today is profitable, it will help the firm to undertake the next best project in a year from now. However, in case of project sequencing, if firms undertake a project and the project becomes unprofitable, the firm will not be able to invest in the second project. So firms really need to be careful when they sequence their projects. Now let's look at the differences between the concepts of unlimited funds and capital rationing. Unlimited access to fund or capital for a firm means the firm has the ability to raise as much fund or as much capital they need to undertake all profitable projects. But in reality, firms need to think about capital rationing because in most cases funds are limited. So in most cases firms need to select the most profitable project first for investment, then they will select other projects. So if a firm's profitable project opportunities exceeds the amount of funds available, the firm must ration or prioritize their capital expenditures with the goal of achieving the value of the firm or the value of the shareholders. Finally, we look at sunk cost versus opportunity cost. Sunk costs are past costs, and these costs cannot be avoided when firms evaluate their projects. So, sunk cost does not affect the accept reject decision of the project. So, these costs should not be included in capital budgeting. For example, a consulting fee paid to a marketing research firm is a sunk cost. So the cost has been already paid, and these costs should not be considered in capital budgeting projects. On the other hand, opportunity cost means what would be earned on next best use of assets. So opportunity cost must be considered in capital budgeting, or in other words, opportunity cost should be considered when a firm will evaluate projects with similar risk characteristics. For example, if a firm decides to build a plant in its own land, the selling price or the value of this land should be considered as opportunity cost of this project, because the farm could sell its land and get some cash from its selling price. So, if a farm builds a plant in its own land, the value of the plant should be considered as opportunity cost, and these costs must be included in capital budgeting projects. It's all about this lecture. In our next lecture, we'll cover net present value.